Welcome back. We're continuing our coverage here from Davos. Joining me now is the man who is steering HCL Tech forward, CVK. It's always a pleasure. Many thanks for joining us here in Davos. We've seen all of you post your results. The expectation was that they would be muted, but in comparison to what the street was expecting, you've delivered, and each one of you has delivered better numbers. What is the sense that you get while you're having conversations here with global CEOs in terms of whether the worst is behind us or the worst is yet to come?
Thank you, Shereen. It's nice to meet you. It's the second time in the last 8 months here in Davos. Yes, I think a lot of results came ahead of expectations. I think the fundamental premise that technology is the biggest differentiator as a strategic advantage for a lot of businesses, I think that's what is playing out. I mean, while customers may reduce a little bit of discretionary spend, but I think the dependence on technology is so high. I think that's why it was a positive outcome. I mean, December quarter is seasonally a weak quarter, so we were growing 5% CQGR for many quarters. On the services business, we grew only 2.2, so that's a little moderation. It's too early to say whether the cycle is going to start picking up again. But from what I'm hearing from a lot of CEOs, what I heard in December and what I'm hearing in January is a little different.
January is better than December?
January seems to spring a little bit more optimism. I think the winter in Europe has been milder. The China COVID situation is much better. So it seems to be a little positivity across the globe.
Are we going to have to learn to live month on month?
Yeah, I think.
Not even quarter on quarter.
Yes, exactly. I think the whole yearly planning, it doesn't make sense. Markets are so volatile, so we should probably plan maybe quarter to quarter, if not month to month.
It's interesting what you were talking about, and it's sort of validated by the PwC Global CEO Survey as well. While they're most pessimistic, the survey, global CEOs, on the outlook as far as the global economy is concerned in over a decade, but the one thing that they agree that they will spend on over the next 12 months is technology. Absolutely. And specifically automation. So
yes.
Are you seeing any indications of any pricing pressure yet, or largely optimization deals? Is that the way forward?
Yeah, I think a lot of customers recognize that the cost of talent has gone up significantly over the last 2 years. And we've been proactively asking them to increase prices. So I think it's kind of created a good balance. At this point, I think pricing is stable. But when you're really pitching a vendor consolidation or a cost takeout deal, we need to bring in a lot of automation into this and commit to the business outcomes. I think when you're able to do that, I think we give a reasonable business case for our clients, and it's really led by automation and efficiency.
So in terms of the deal pipeline, do you anticipate any slowdown at this point in time, or at least in some specific geographies like Europe, which is what the commentary seems to suggest?
Yeah, I think the deal pipeline continues to grow, but I think there are two variations. One is there was a good mix of digital transformation deals and cost optimization deals, and there is a Venn diagram which is digital transformation leading to cost optimization. Now we see a little more of cost optimization and transformation which is leading to cost optimization than just a pure play transformation. That's one. And I think the pipeline is also a little more skewed towards US than Europe, because Europe is a little slow in decision making, as I called out in the quarterly results.
With this change that you were just talking about, with the focus being on optimization deals as well as the pressure on pricing, etc., the kind of almost 23% margins that we saw through the course of COVID, and of course now we're back down to the 18-20 levels. Is this likely to be the sort of sustainable range going forward?
No, I think our sustainable range, what we believe is the pre-COVID levels, which is 19 to 20%. We are at average last 3 quarters, we are about 18.2. We think we will gradually inch up to our 19 to 20 range. We have several levers, including efficiency, more freshers, realization, and all of that will lead to, and a lot of managed services deals where we can bring in more optimization. I think we should get to 19 to 20 in the next few quarters.
You talked about people. You're hiring, what, about 30,000 people? That is the number that you've put out?
30,000 freshers.
30,000 freshers in the next year. In terms of utilization, what is the current situation?
We don't call out utilization itself, but of course, in the September quarter, that's really the peak quarter for a lot of freshers. We hired almost 10,000 freshers. So they are only partly deployed. Maybe half of them are deployed. Other half are still undergoing training. And we hired about 5,000 plus freshers in the December quarter. So they're all in training. They will get into deployment in the next couple of quarters.
It's been 6 years now for you, CVK, at HCL Tech, steering the ship, so to speak. As you look at what's happening, the changes in technology, the changes as far as global macros are concerned, is there likely to be any shift in strategy from what you've been doing in the last few years?
See, I think I continue to see very, very big opportunities, right, for a tech services company like us. For example, the sustainability solutions and services around sustainability is expected to be $10 trillion in the next decade. So this will mean significant amount of services, opportunities, and opportunities to build products, engineer products and solutions. So I think it's like really the next digital. So I think this industry is pivoting from cost optimization to business impact and digital transformation to really building sustainable solutions. So I think I remain very excited about the opportunities ahead, especially in the current level of focus on sustainability is going to drive a lot of innovation in this space.
You know, you're talking about innovation, and I think one of the areas of conversation and a lot of buzz around it is what's happening as far as things like ChatGPT is concerned. What do you make of that, and what could it mean?
I'm really worried, like people like you are going to have a lot more time. No, they're going to have more time, and you're going to ask all kind of questions. So, but jokes apart, I think it's a very, very interesting technology. I think it can potentially create a lot of impact on the customer service and content creation kind of industries, but it's still early days. I do think there will be an ecosystem which will evolve around ChatGPT, which will drive a lot of new solutions. But like any new technology, it is early days. We have to do more due diligence, and we continue to deploy it in a lot of our COEs, look for how best we can kind of use open AI and generative AI solutions.
You know, so speaking of new technologies as well as new opportunities, are you in the market scouting for anything specific at this point in time?
No, see, our acquisition strategy has become very, very specific, right? We are focused on if there are some niche capabilities or niche geographies, that's where we are focused on, so nothing big.
Nothing big at this point in time. What is the thing that you're most concerned about? What is the single biggest risk that you're worried about at this point?
I think, we were very comfortable with the yearly planning, 3-year planning, 5-year planning. I think those cycles are not really relevant because there's so much volatility, and how do you really pivot the organization, the opportunities, around the opportunities. I think that's something which, it's not a worry, but it's really a good challenge to really go after. How can you be very nimble around opportunities and really go after them?
What does that mean now? If there's no 5, 3, 2-year cycle plan, what is the duration of a plan?
I think we should plan. We should do a H1 plan and a H2 plan, or do a yearly plan, but with a clear objective of revisiting at the end of H1, so that you can incorporate whatever macro changes onto your plans.
So at the end of the calendar year that we've just seen, any changes necessary, you think?
No, I think we gave a guidance of 12 to 14%, but we have said we will get to the higher end, which is 13.5 to 14. So I don't foresee any changes. We've done well. First half was extremely good. We delivered industry-leading growth. Our services business has delivered last 2 quarters among the highest growth in the industry, in the tier 1 players. And we are also very focused on quality of revenue, right? There's lots of revenue available. You can take over data centers, all that. We are very focused on what will really be sustainable in the long term. So quality of revenue is a very important element as we continue to grow.
You know, that's interesting, and that's why I'll end, because yesterday when I was chatting with CP Gurnani of Tech Mahindra, he said they're going to shift their focus on high-yield markets and high-yield businesses as well. And that seems to be what you're saying also.
Yeah, it's markets. Of course, some markets are more attractive than other markets, so that's where we are focused. But even within the markets, what are the solutions, and how do you want to drive higher value services rather than more commoditized hosting and assets and things like that? It's really pure services and higher end services. That's what we are more and more focused on.
So confident about 2023?
Looks like that. I think technology is the biggest strategic advantage for clients. So I think there can be some small drops in discretionary spend, but overall I remain very optimistic.
CVK, always a pleasure. Appreciate you joining us here on CNBC-TV18. Thanks for stopping by in Davos.
Thank you. Thank you.
Well, we will take a break, but the conversations continue here on CNBC-TV18. We're back in a moment with more. Stay tuned.